Welcome to the DIY Wealth Canada podcast, a show by independent investors for independent investors. Join hosts Bob and Nelson as they discuss investing, personal finance, and much more, all from a fiercely self-reliant Canadian perspective. As a reminder, nothing you're about to hear is investment advice. Thanks for listening and enjoy the show. Hi, everyone. I'm Nelson. I'm here with Bob, and we are the DIY Wealth Canada podcast. Today, we are going to be talking about our favorite Canadian dividend stocks. We're going to have a few different names that each of us like, and we're just going to talk about more generally sort of what we're looking for in terms of our favorite Canadian dividend stocks. I'm sure this won't be the least bit controversial, and everyone will agree with our picks, won't they, Bob?
Yeah, for sure. There's always opinion on which ones are the best.
Yeah, isn't there? And let's kind of dive right in, because that's the first point that I want to make, is that it doesn't matter what my favorite Canadian dividend stock, what yours is, or what anyone else's is. The thing that's important is what you're looking for as an investor and what you identify as the qualities that you want. So for instance, I'm thinking about my friend Ed here. He is, I think he's about 80 years old now. Sorry for outing your age, Ed, if you're listening. And he wants high dividends today. His thought process is, I don't have that many years left, so I want to get paid today. And the 20-somethings who are listening are like, Ed, what are you doing? You want dividend growth. You want something with a smaller yield that's going to grow over time. But he doesn't want that because he's just not at the stage of his life where that makes a lot of sense. He can't afford to play the long game anymore. And that's the important part of this discussion, and looking at things from or from your own perspective is figuring out what you want and then going from there. So for you, Bob, you're more interested in dividend growth versus current yield, are you not?
I would say about 50-50, because we're getting to a point where we're pretty close to live off our dividends or live off our portfolio. So we definitely want some cash flow from our dividend portfolio or portfolio in general, but we also want to have that growth aspect. So I would say 50-50, but we used to lean more on the dividend growth perspective. And Nelson, I assume for you, it would be similar as well, maybe a little bit lean toward cash flow for your perspective.
Yeah, I'll talk a little bit about my journey in this, because for me, kind of in this sort of the late 2010s, early 2020s, early retirement was a goal of mine. I went from thinking early retirement was stupid to figuring out why people were so attracted to it. And of course, for me, it was, I didn't want to stop working forever. I liked to work, etc. And what I realized was that it's the flexibility, it's the optionality that matters. So for me, it was this emphasis on cash flow to get to that finish line. And then from there, what I realized is that when I did that, is I didn't have enough emphasis on dividend growth. My portfolio or my dividend income would grow over time, but I think I wanted it to grow a little bit more over time. There just wasn't quite enough growth there. So I made a couple decisions to accelerate that a little bit. One is that I made the decision to reinvest some of my dividends. So I withdraw some, I reinvest some. And that added to the dividend growth aspect of it. You're adding money to a portfolio, you're going to increase your dividends. The second thing that I did is that I put more of an emphasis on dividend growth in the last 2 to 3 years. And basically, I don't want a huge amount of dividend growth, but I'm just looking for that little bit extra. Where before, I would be happy to buy something that had a big yield that didn't really increase that yield that much because, hey, that I wanted the cash flow. So I've just changed it a little bit. And my portfolio has gone from maybe growing the dividends from 3 to 4% a year to kind of that 5 to 6% a year. And it's just a slow process that I will focus a little bit more on dividend growth in the future. So, to kind of wrap that up, maybe 5 years ago, it was 70% yield, 30% growth. And now it's closer to your ratio there, Bob, 50-50. Do you envision that changing when you retire, or is it, like, can you, like, for me, it was when I got to that level, I could see the finish line and I wanted to keep pushing. So do you see that changing, or is this like kind of this 50-50 split you're at that's good for a while?
I think the 50-50 split is good for us, and I don't envision us shifting over to one side or the other too much. I'm just thinking if you end up shifting too much to the cash flow side or the yield side, you could get into the yield trap, right? And or you may start investing in. I mean, we just talked about it a few weeks ago. These high yield ETFs like the whatever TLSYs, like the EO Max ETFs, and you could get into danger pretty quickly there, and it's a slippery slope. So I think stick with the 50-50 makes sense. And also it also depends on what stage of life you're at. So you and I were in our 40s. We still have quite a way for us. So we need to make sure our portfolio is growing, our dividend income is growing such that we keep up with the inflation. Now, if you're much later in your stage of life, in your 70s or 80s, and maybe the growth isn't as big of an importance for you, so maybe you lean more toward the yield side. So that again, it just depends on where you're at and where your focus may be. Right? So it's different for everybody, and that's why when we talk about best dividend stock in Canada, it's quite general because it could be very different for some people, especially if you're more leaning toward income for sure, or if you're leaning more toward dividend growth. So we're just keep that in mind when we talk about our picks.
Yeah, exactly that. And I know that we're going to cover a little bit of a higher yield choices, bit of a lower yield choices as well. But I just want to talk about dividend growth a little bit more because, like you said, Bob, we have hopefully a few decades of life ahead of us, and you get to the point where you realize that without that growth, without something pushing the dividend ever higher over time, you do run that risk of eventually running out of inflation adjusted money. But I think too, when you focus a little bit more on dividend growth, what you're doing is you're really focusing your portfolio a little bit more on total return rather than just income. And from that philosophy, you will generally end up with a little bit more money over time, which should ultimately be the best portfolio protection that you can get. Because if you end up with more money, if you end up with higher capital gains, then you, in the future, rather than pivoting everything to higher dividend, you have the option to sell a little bit of your holdings. Now, I know that for a lot of people, selling is terrible. They don't want to do it, but it is an option in the future if you just focus a little bit more on the growth and on the total return. I know that you talked about a little bit about selling some of your names in retirement. Can you very quickly just kind of go over that before we actually get to our individual favorite dividend stocks?
Yeah, I think living off dividends is a goal for sure, but I think for the first maybe 3 to 5 years, just relying on dividends, it gives us a little bit more margin of safety. So not having to touch the portfolio, not having to sell anything from our portfolio. Again, just a little bit margin of safety. But eventually we do think it makes sense to sell a little bit of our portfolio and then kind of rely on both dividend income and also the withdrawal from our portfolio to sustain our retirement lifestyle. And that also means, our expenses may not increase that dramatically, but maybe that means we could sell and fund our kids post-secondary education, or help them a little bit as they move to adulthood. So again, just gives you a little bit more flexibility. And also, if you 1 year we decide to travel in style, we could do that rather than completely rely on dividend income. So that's why total return is important end of the day, because it will give you a little bit more flexibility than completely rely on dividend income. So that's kind of our train of thought here when it comes to eventually withdrawal from our portfolio or not.
Okay, let's now move on to actual individual stocks. I'm going to let you, Bob, go first. I want to talk about Canadian banks. These are a favorite of probably a lot of people listening. They're very popular choices for Canadian investors, Canadian dividend growth investors. They offer a fantastic combination of pretty good dividend yields and dividend growth. So what's your favorite Canadian bank stock? If you had to choose one, which one would you choose?
Oh, that's a very tough question, Nelson. So I, like most Canadians, like the Canadian banks. So by the Canadian banks, I guess I mean the big fives. So the TD, the Royal Bank, the BMO, the Bank of Montreal, and the CIBC. Now you could throw in National Bank in there as well, makes it six. And if you really want to pick and choose, you could technically add EQB, which is the online bank that's done really well. So those are seven banks you could choose from. I would avoid Floridian. We made a mistake years ago, so I wouldn't talk about that. But if you stick with like the 6 or 7 I mentioned, they're all pretty solid. Now you may have preference over like prefer one over the other. That's totally fine. For us, we own all 6. So the big 5 plus National Bank. Now we don't do equal way exposure for all 6. We definitely have a few make up a little bit heavier in our portfolio. So like the reason why we like the Canadian banks, a lot of the Canadians like them as well, is if you look at the big fives, they've been paying dividends since the late 1800s and they have not stopped paying. So they pay dividend every single year since the late 1800s, uninterrupted. So that's quite powerful itself. Now they haven't grown the dividend payout every single year, but a track record of over 200 years is really decent if you ask me. Now, if I had to handpick out of those, 7 I mentioned, I would probably go between either TD or National Bank. TD I like because they're one of the biggest banks in Canada. I bank with TD. The only reason I bank with TD is because my parents bank with TD, and when they open up an account for me, naturally they went with TD, and I have stuck with TD ever since. And I think a lot of people probably fall in the same camp as me, right? Their parents bank with TD, therefore they bank with TD, and they haven't switched since. Now, TD's big in Canada, but they're also big in the US. They have expanded into the US many years ago, and then they have a pretty big exposure in the US. So I like TD for that particular reason. They're big in Canada and in the US, so they have a lot of revenue coming from both countries. I also like National Bank because they're the smaller of these, or the smallest of the 6. National Bank primarily operate out of Quebec. Now they had just recently finished acquiring Canadian Western Bank to increase their exposure on the west side of the country. So I like National Bank because they still have a lot of room to grow compared to the big 5. So yeah, those are good, I think, and they've been growing dividend payout for a number of years. Now, I think National Bank may have cut dividends during the financial crisis, but TD didn't, and I think many of the other Canadian banks didn't as well. And again, both National Bank and TD have done quite well. Now, TD got into a bit of trouble with their money laundry scandal recently, but they switched their CEO quickly and then changed the board, and that have and instill some confidence in the investors. So the TD share price has recovered since. So yeah, those two are kind of my favorites, the Canadian banks. Now, Nelson, I think you have another pick that you quite like out of the Canadian banks.
Yeah, so like you, Bob, I own all 6 of the big 6, and my strategy is very simple. It is when a Canadian bank stock trades at a 52-week low, I am there buying more. And I don't pick and choose each name. It's a rule that it doesn't matter which of the big 6 is there. I'm showing up and I'm buying more. And I think that 52-week level is a wonderful way to look at it because it forces you to buy them when they're cheap. And what happens is that you have a 52-week low every year, but you don't have the ability to buy at a 52-week low every year. If something's just sort of steadily marching higher, then you just sit and wait, and then I'm happy to buy when they're at a low. Now, what happens in like 2023, in the latter part of that year, there were multiple Canadian banks that all hit 52-week lows at once. So what I do in that situation is I rank them by quality, and then I'll buy the highest quality ones first. And then if the opportunity persists, then I'll continue to buy the lower quality ones. And so in terms of quality, for me, the number 1 Canadian bank stock is Royal Bank. It is just the management is so good. I'm always impressed when they talk about they are either number 1 or number 2 in every important Canadian banking category, whether it's wealth management, whether it's mortgages, whether it's deposits, whether it's credit cards, you name it, they're either number 1 or number 2. They do a good job in virtually everything that they do. They have a steady share repurchase program, which caught me by surprise when I realized it. I think it's like 8 of the last 10 years they've repurchased shares, and the only time they haven't is when they've issued shares to help pay for acquisition. So more recently, that's the acquisition of HSBC Canada, and then before that, when they bought City National in the United States, that was when they issued shares. And then in between times, they just steadily move some of their spare cash into repurchasing shares, which I really like. But Royal Bank is a smaller payout ratio than a lot of its peers. It's kind of in that 40 to 45% range, which I like. That makes the dividend safer. It has a wonderful record of paying dividends, like Bob said. All the Canadian banks do, but Royal Bank, their dividend growth has been a little higher than a lot of their peers, especially when you look at like a Scotiabank or a CIBC. Royal Bank has surpassed them in terms of dividend growth in the last decade. And just total returns for Royal Bank over the last 20, 25 years have been consistent, kind of 11, 12% per year, including dividends, which is just it's good enough for me. And you just combine all those things together, and I'm such a fan of Royal Bank, and I'll say that it is the largest individual holding in my portfolio of one that includes, like I said, every single Canadian bank. I love it. I'm a client, and I just like every time I pay for a bank fee or whatever, at least I feel pretty good about paying myself rather than paying someone else. So that's my thought process for Royal Bank.
Yeah, that's excellent. And I think the buying 52 week low strategy has worked quite well for us for Canadian banks over the years too. Like looking at the Royal Bank chart, I definitely regret a little bit that we didn't buy more when it was at 52 week low earlier this year and over the years. But we, like yourself, Nelson, we got a sizable Royal Bank, so we done well for sure, especially in the recent quarter they announced, and I think the share price shot up the very next day. So yeah, definitely rewarded the shareholders for sure.
Yeah, I'll just caution the 52-week low strategy. It's a great strategy. It's worked really well for me. Bobby says worked well for you too. What's going to happen when you implement that strategy is you're going to go on Twitter, you're going to go on Reddit, you're going to go on wherever, and you're going to get a bunch of investors saying that the Canadian banks are doomed. It happens every time they hit a 52-week low. It's going to happen every time after they hit a 52-week low. And your job at that point is to forget about the short term and think about that these companies have been around for, in Bank of Montreal's case, more than 200 years. Bank of Montreal is the oldest bank in Canada, and it's been around for more than 200 years. And so it's your job at that point to say, what's more likely, that this stumble that the market is worried about right now is going to affect the stock over the long term, or that a company that's been around for 200 years can figure out a downturn that happens once every couple of years. For me, it's just a no-brainer that these guys will figure it out. They figured out the 2008 crisis. They figured out 2020 without much of a problem at all. So that's what I would just caution people, that it's going to look bad when you buy, but be brave and buy. It'll work out.
Yeah, just to add to that, like if I were to listen to the Canadian bank shorts, I would be losing a lot of money for sure, rather than longing Canadian banks over the years. So I would not bet
they've been wrong.
The banks for sure.
I was just going to say, the shorts have been wrong for 15 years and counting. I remember in 2009, 2010, it was, okay, the American housing market blew up and now the Canadian housing market is going to blow up. It's just a matter of time. And thank God I didn't listen to those shorts back then, because that was a terrible call and they got it wrong. But yeah, anyway, let's move on, because I don't want to talk about shorts.
Yeah, they might get 1 year right, but what's their track record, right? So yeah, let's move on to another pick. For me, I also like Intact Financial quite a bit. Intact Financial is in the insurance space. I think I mentioned this before. It's one of the first dividend stocks that we purchased. It's good because it kind of in a different space compared to Manulife and Sun Life, which you might be more familiar with in terms of the insurance space. But Intact Financial, they're Canada's large provider of property and casualty insurance, right? So they insure over 5 million individuals and businesses through its insurance subsidiaries. And like our house insurance when it's through Intact Financial, for example. So it's kind of nice to know that we use something that we own. And the company, I think, has something like 20 years of dividend increase streak, and they've been steadily increasing their dividend payout over the years. The dividend payout ratio is still relatively low. And if you look at the stock chart, the price has been increasing over the years. So that's something that's done really well over the years. Now, Intact Financial definitely in the lower yield aspect. I think the yield is less than 2%, but they've been increasing dividend growth quite steadily over the years. So, and again, share price has been increasing. So it's one of those that you purchase for the total return aspect rather than the cash flow side of things. Nelson, what about you? Another pick from you?
Well, first I want to talk about Intact Financial a little more, because I love this pick and I love Intact as a company. And for me, I've only owned this one since 2020 is when I bought it. And what happened is insurance rates were going up. I was upset because my car insurance was going up. And I thought to myself, we talked a few weeks ago about hedging our consumption. And for me, it was like, I want to hedge this consumption. I'm so annoyed having to pay my insurance bill. What do I do? Well, the answer was very simple. I buy Intact shares, and then every year when I pay my car insurance, which is not Intact, by the way, it's a different company, but I get to feel that little bit of satisfaction after buying Intact because I'm paying myself. And for me, that was the motivator behind it. But of course, all the other things too were that Bobby talked about in terms of dividend growth and overall growth. Total return has been excellent. I believe it's about 12 or 13% per year since the IPO in 2005, which is just like wonderful. Like that kind of return over the long term will do very well for you. So you have all these things going for Intact. I think just makes it a fantastic choice for a lot of people listening. And two, I'll mention that Intact's CEO is a guy named Charles Brindamore. He gets no attention, even in the insurance space, because the insurance space, when people talk about insurance CEOs, they're Prem Watsa is the guy they talk about, who is Fairfax Financial. He's kind of Canada's Warren Buffett. Everyone sort of heard of Prem Watsa, but Intact and Charles Brindamore, he has grown Intact from a Canadian P&C insurer to a worldwide P&C insurer. He made acquisitions in the United States, made acquisitions in Europe, and Intact has a demonstrated history of acquiring assets, sending their people in, and getting their combined ratio down. Combined ratio for insurance is the measure of how many claims are paid out versus premiums coming in. It's a little bit more complicated than that, but that's sort of the gist of it. And what Brindamore has done is has this ability to bring the combined ratio down, which is what you want in insurance, on these new acquisitions over time. So Intact can they can buy something in the UK, and they can use their expertise to make this more profitable. So what that means over the long term is that Intact should be able to continue making acquisitions in the insurance space and bringing those acquisitions, making them more profitable, which is just such a wonderful thing for a company to have. This is one I own for I plan to own for a very long time. I think it's wonderful, and I just wanted to add that color to that. Okay, so I'm going to talk next about Capital Power. Bob, is this one that you own? Are you very familiar with it? I know it's a little bit of a niche sort of name, which is kind of why I wanted to bring it up. But is this one that you have in your portfolio?
Absolutely. We also own Capital Power as well.
Okay, well, let me talk about it, and then I'll let you add your thoughts to it as well for what I missed. So Capital Power owns natural gas-fired power plants. They own some renewable power plants as well, but most of it is natural gas-fired. A lot of it is in Alberta. In fact, the power plant that is powering my microphone right now, my computer right now, is a Capital Power plant. So for me, that was immediately attractive. But what I like about the business is that it generates all sorts of cash flow. Basically, what happens is that in a world where more and more people want renewable power, that's where the growth is. That's what these big companies want because they want to reduce their carbon footprint. There's these natural gas power plants that just sort of exist, and they generate a lot of power, and it's a cleaner power than the previous version, coal. So, I talked about that power plant. That used to be a coal power plant, and now it's a natural gas power plant. So Capital Power is helping move everything in the right direction. It's maybe not as good as what we might want, but we're getting there. Natural gas is a important sort of buffer between coal and fully renewable, which I think we will get to eventually. So you have these natural gas assets that don't really attract a lot of attention. So what Capital Power can do is they can go into the marketplace, they can buy these assets, and that's what they've been doing in the United States, that generate a lot of cash flow, but it doesn't cost Capital Power very much to buy them. So for me, from a dividend perspective, what I like is when a company can go into the market, buy assets that immediately generate a lot of cash flow, and that cash flow can get paid back to me in terms of a generous dividend. So right now, Capital Power yields about, I think it's a little under 5%. And the dividend growth over the last sort of 5 to 10 years has been in that 5 to 6% range every year. I think it's a wonderful combination of high dividends now, but also that growth in the future. Bob, you talked about that 50-50 split between growth and yield. And I think Capital Power is one of the few dividend stocks in Canada that checks off both of those boxes pretty much equally. So what did I miss? What do you think about Capital Power?
Yeah, when I think about Capital Power, what you said is definitely true. Like the natural gas power, it's definitely cleaner than coal power plants. What I like about Capital Power, and this is in their investor presentation as well, is that we talk about AI nowadays and data center and clouds. Is like clouds in particular, like the demand for power for data center, like AI data center, the cloud data center, et cetera, that demand for power is increasing. And I think Capital Power says like 17% compound annual growth rate. So the demand, like the data center is growing. So you can imagine the demand for electricity and power is growing as a result as well. So these data center are looking for companies to supply electricity. So Capital Power has been getting a lot of demands as a result. And I also like Capital Power. They're not just looking at natural gas, they're also looking at renewable energy power plants. So they actually have 5 projects ongoing in Alberta and Ontario, which will generate additional about 350 megawatt of power, right? So about half of that will be from wind, I think. Actually, yeah, about a third will come from wind, and then about 2/3 will come from solar. So that's a good thing that they're continuously trying to make their power generation via renewable. So I like that. Now, it's just a company that's kind of under the radar a little bit because people always look for the sexier name. And for me, Capital Power it's not a lot of people talk about it, but they've been kind of solid, just chugging along in the background. Now the yield is higher, so that's a benefit you're looking for cash flow as well. It's a little bit like Intact Financial that we just talked about. They kind of chug along in the background. People don't really talk about them. That's why I like Capital Power and Intact Financial so much.
I really like your thoughts on the data center aspect of it, because you are exactly right. The growth there is really astounding. And it's something that I think a lot of, let's call them maybe less astute listeners, are really not understanding, is that these data centers, they take up a lot of power, and the renewable sources just don't make sense for these data centers. One is they just take up too much power. You can't just throw a bunch of solar panels on a roof and have it power itself for the data center. It doesn't work. It needs way more power than that. And secondly is that when there's inclement weather, and that weather impacts renewable energy sources, as we saw in Texas. What was that, last year, 2 years ago? I can't remember what that was. Even in Alberta here, we get to minus 35, minus 40, kind of once or twice per year. And what happens in that scenario is that solar and wind don't work very well, if they work at all. And we need natural gas to step in that situation and power everything, whether it's a data center or anything else, is that natural gas is needed for that base power. So if we locate data centers in Alberta, which Alberta is talking about, I think Alberta would love to have a data center or two here. They need natural gas to power them. They need that uninterrupted energy supply. That could come from nuclear too. But the point is that they need that. And that's going to make, I think, natural gas fired power kind of all the more important in the future, which translates into higher power prices for individuals, for data center customers, but for guys like you and me, Bob, higher dividends. When a company can push through price increases, like I think the power companies are going to be able to do in the future, that bodes well for future dividends.
Absolutely. Now, my other pick, now this might be a little bit controversial. My other pick would be Enbridge. So Enbridge is probably a name pretty familiar to most of the listeners. It's a pipeline company, right? So Enbridge is one of the leading North American infrastructure companies, and they have a vast network of pipelines. I think over 192,000 miles of natural gas and NGL pipelines across North America and the Gulf of Mexico, or if you're Trump is Gulf of America. But they provide, transportation for natural gas and crude oil, so allow companies to move natural gas and crude oil across North America. And yeah, sure, a lot of that transportation is done via rail, but quite often it's faster to go through pipelines. And why do I like Enbridge? First of all, that's not talk about the dividend side of things for now. But what I like about Enbridge is if you think about the current situation is that it's getting less and less likely for companies to build new pipelines. So what does that mean to companies like Enbridge that has an existing network of pipelines? Is these pipelines are even worth more than before because you can't build new ones. So they're quite valuable by having a vast network of pipelines for Enbridge. And our reliance on natural gas and crude oil isn't going away anytime soon. Sure, we have EVs and things like that, but we're still relying on natural gas and crude oil. Let's be frank here. So we need to somehow rely on Enbridge to transport these valuable assets across North America. And why not invest in Enbridge and reap the rewards a little bit? Enbridge, its yields a little bit higher than some of the stocks, right? I think it's about 5% yield. It used to be higher because the share price was lower, but yeah, it's been growing dividend payout quite steadily over the years. I think the dividend increase streak is close to 30 years now, so it's been increasing steadily. And yeah, it's a well-known name and it's done well over the years. So that's one of the picks I would go with. Nelson, you want to talk about Enbridge a little bit? Do you own that in your portfolio?
Yep. I do own some Enbridge. It's a relatively large position for me for a lot of the reasons that Bob mentioned. It's solid. I do like the natural gas, oil transportation play. Bob, like you said, that it's not going away anytime soon. And the government, as much as the new prime minister is talking about making pipeline projects easier, I think that is a tough sell to a lot of parts of the country, and it may not be as easy to expand on the current network as what we think. In terms of moving crude oil from west to east in Canada, you really just have Enbridge Line 3 as the option. And we have to get crude oil from the western part of the country to the eastern part of the country. There's refineries there. It's our oil. We should refine it and we should produce it, or we should consume it here in Canada. And that's it. If you want to move that west to east, you really only have that one option. I like that moat. That's the kind of moat that I can see and touch, and it's very easy to understand. The other thing I like about Enbridge is they have this pivot into the natural gas utility side. So of course in Ontario, many of the people listening have Enbridge as their natural gas provider. And Enbridge has also made a couple acquisitions in the US to expand into the utility business there. I like that in terms of a more steady cash flow kind of situation. And you get the ability to increase prices to those customers as well. So I like that too from that perspective. I'm going to just quickly talk about one more here. I know, Bob, we're almost out of time. So I will throw out Dollarama as a choice. And I'm doing this with a bit of a caveat because I know what the response is going to be, is that Dollarama is very, very overvalued. And those people, I would say maybe you're onto something, because last I looked, it traded at about 40 times forward earnings expectations, which is very, very high. And it's not normally something that I would go for. We talked about how I buy Canadian banks at 52-week lows, and Dollarama is the furthest thing almost from a 52-week low. But Dollarama is a wonderful business. What I like about Dollarama, we studied Dollarama when I was in the grocery business, and what we sort of discovered with them is that when you only have a store that's 10 to 15,000 square feet, you can limit the selection of products that you have. So basically what you do is you just limit it to things that move fast and that are very profitable. And in doing that, Dollarama has been able to expand their network across Canada. So from there, then you've got the expansion into Latin America. I was in Colombia. I went to a Dollar City store, and it is an exact clone of Walmart, exact clone of Dollarama. Sorry, not Walmart. And you've got this wonderful business that replicates throughout the world. They're smart operators. They're doing a lot of things right. Gross margins are fantastic for a retailer. It's just a wonderful, wonderful business. And sometimes wonderful businesses trade at a very high multiple. So that's my quick Dollarama pick. And Bob, I think you have one more for us. Which one would you like to talk about?
Sure. Just one last pick before we run out of time. I like Waste Connections quite a bit. For those that are not familiar with Waste Connections, they're the Canadian version of waste management. So they are into waste disposal. So why do I like Waste Connections? We probably heard about two certainties in life and death, right? But I would kind of put that making garbage is not pretty certain in our human life. So I like Waste Connection for in the aspect that it's in the garbage disposal business, which is basically a guarantee business for humans. And it's the third largest solid waste company in North America. It operates out of the US and Canada. The revenues come about 85% US, 15% Canada. And the business is easy to understand, right? So it collects waste it charges money to remove waste, and then it kind of expose waste, but it also use the waste to generate some other energy and sell those energy to other businesses. So it's very easy to understand, and the share prices have done quite well over the years. Now, Waste Connections doesn't have the highest yield. I think the yield is less than 1%, but the dividend payout growth has been pretty good over the years. So that's something for younger investors that might be quite interesting for them in terms of a higher dividend growth over the years. So that would be my last pick before we wrap up for today.
Yeah, I like that one as well. You talked about the garbage business and how, there's garbage is a certainty in today's world. And when Waste Connections, when they get a contract with a municipality, that's generally a pretty sticky contract, right? Like it's a pain for a municipality to change their garbage provider. Like, why would you if the provider's doing a good job at a reasonable price? So once that business is seized, then you generally have that cash flow for a long time, and investors are willing to put a premium on that because it's very dependable. And it's, Bob, the income growth in terms of their earnings, it's been spectacular over the years. They've been very consistent in growing the bottom line 8, 10, 12% a year, maybe even higher. I don't know what it is, but that's growth, and you got to pay up for growth sometimes.
For sure. And like what you said, I like Dollarama as well. We don't own Dollarama in our portfolio just simply because we already own too many individual stocks. So we're actually looking to shrink that holding a little bit. So you can't own them all, but I hope with our few picks kind of gives the listeners a little bit idea what are some of the best dividend stocks in Canada you could invest in.
Exactly that. And just to wrap it up, anyone who's listening, if you're listening to this episode, tag me, tag Bob on Twitter, X, whatever you want to call it, and just let us know what your favorite Canadian dividend stocks are. We love to hear everyone's opinion because, like we said at the top, this is a pretty diverse subject. Everyone's going to have a favorite choice, and we want to hear your choices because that's kind of fun for us. We'll have a tweet up that will talk about this episode, and we'll invite everyone to have their opinion on that. So, Bob, anything else you want to add before we wrap it up?
No, I think, again, let us know what your thoughts are. And again, like, these are just some of our picks. Obviously, we could go on and on. And also, our picks is, it depends on where you are in your investment or in your investment career, like whether you're using cash flow versus growth, as we talked about earlier in the episode. So always keep that in mind. And yeah, we would love to hear your pick. So let us know.
All right. Thanks, everyone, for listening, and we will talk to you again soon.
If you enjoyed the show, make sure you subscribe to never miss another episode. For more from Bob, visit his site at tawcan.com. That's TAWCAN, all one word. Nelson can be found at CanadianDividendInvesting.com. They're both on Twitter as well. Just search for Tawcan or CDI Newsletter. Thanks. See you next time.